Imagine being able to predict your financial future with just a glance at a piece of paper. That's exactly what you can achieve by learning how to take a personal financial balance sheet. Today, I'll show you how this simple document can be the compass that guides your journey towards financial security. In this video, I will guide you step by step through the process of creating your own personal financial balance. From identifying your assets and liabilities to calculating your net worth, I will teach you how to do it in an easy and understandable way, even if you are a beginner in finance. A personal financial statement is not just a boring term that accountants use. It is a powerful and accessible tool for anyone who wants to take control of their finances. It allows you to clearly see where you stand today and plan where you want to go tomorrow. Before we dive in, if you like what you're hearing, please like this video, subscribe to the channel for more content like this, and share your thoughts or questions in the comments. Let's demystify personal finance together and put them to work in your favor. Let's start by breaking down what exactly a personal financial statement is. Essentially, it is a document that summarizes your assets, what you own, your liabilities, what you owe, and your net worth, the difference between the two. Think of it as a snapshot of your financial situation at any given moment. It allows you to have a clear view of your finances, which is vital for making informed decisions about your money. A personal balance sheet is more than just numbers on a piece of paper. It is a tool of power. It helps you understand your true financial position, identify areas for improvement, and plan for the future. For example, by clearly seeing your debts, you can make a plan to pay them off, or by knowing the total value of your assets, you can make more informed decisions about investing or saving. Unlike company or business balance sheets, a personal financial balance sheet is simpler and more direct. It focuses on your individual or family finances and does not include more complex elements such as cash flow or profits and losses. However, like business balance sheets, it provides you with a solid basis for making financial decisions. Keeping a personal financial balance regularly has multiple benefits. It allows you, for example, monitor your financial progress over time. Make adjustments to your savings and investment strategy based on concrete facts. Quickly identify and correct financial problems before they worsen. Establish and achieve short, medium, and long-term financial goals, such as buying a house, educating your children, or retiring. In short, a personal financial balance is an essential and accessible tool for anyone who wants to have more effective control over their finances. Throughout the video, we will guide you through the specific steps to create and analyze your own balance sheet, putting this practical and valuable knowledge directly in your hands. Before we dive into the details of how to create your personal financial balance, it is crucial to prepare properly. Preparation is the key to ensuring that the process is efficient, accurate, and, above all, useful for your financial planning. The first step in preparation is to gather all relevant financial information and documents. This includes bank statements, investment documents, loan and mortgage information, and any other financial records. Having this information on hand will give you a clear base from which to start. It is helpful to organize these documents by categories: assets, liabilities, and any sources of income. Next, decide what tools you will use to create your balance sheet. You can opt for simple methods like an Excel spreadsheet or personal finance apps that can offer additional templates and features to make the process easier. Choose the tool that is most comfortable and accessible for you. If you're new to this, a basic spreadsheet can be a good starting point. I'll leave one in the video description so you can get started. In addition to physical tools, prepare your mentality. Maintaining a financial balance requires honesty with yourself and a commitment to accuracy. Establish the habit of regularly reviewing and updating your balance sheet. This not only helps you maintain a clear view of your financial situation, but also encourages financial discipline and responsibility. It is important to be consistent in how you categorize and value your assets and liabilities. Decide on an approach and stick with it over time. This will allow you to make meaningful comparisons and track your progress effectively. For example, if you choose to value your real estate at market prices, continue this method with each update of your balance sheet. Good preparation is the basis for creating an effective personal financial balance. With your documents organized, your tools selected, and the right mindset, you're ready to start building a clear picture of your financial situation. Now, let's dive into how to identify and categorize your assets. A crucial part of your personal financial balance is identifying your assets. Assets are basically anything you own that has economic value. This step is more than just listing your belongings. It is a careful and realistic assessment of your financial resources. Let's start by classifying your assets. Generally, these fall into two categories: liquid assets and illiquid assets. Liquid assets include cash, bank accounts, and any investments that can be quickly converted into cash, such as stocks or mutual funds. Illiquid assets, on the other hand, encompass things like real estate, vehicles, artwork, and other assets that cannot be liquidated as easily. Now, let's move on to identifying and valuing your assets. For liquid assets, the process is relatively simple. Check your bank and investment statements for current values. In the case of illiquid assets, the valuation can be more complex. For example, for a real estate property, you may consider its current market value, which may require a professional appraisal or research of prices of similar properties in your area. When valuing your assets, it is crucial to be realistic and objective. Avoid overestimating the value of items due to sentimental value. If you are having difficulty valuing certain assets, such as collections or jewelry, it may be helpful to seek the opinion of an expert or appraiser. Once you have identified and valued your assets, record this information in a clear and organized manner. You can do it in a spreadsheet, detailing each asset with its corresponding value. This documentation will be the basis for calculating your net worth later. Identifying and valuing your assets is a fundamental step in creating your personal financial balance. It gives you a clear view of what you own and is half the equation in determining your financial health. Now, we'll focus on the other half of that equation: your liabilities. Liabilities are all the debts and financial obligations you have. They include everything from mortgage and vehicle loans to credit card balances and personal loans. Understanding your liabilities is crucial, as they reflect the obligations you must meet and have a direct impact on your net worth. As with assets, liabilities can be classified into different categories. Short-term liabilities are debts that you need to pay off in a year or less, such as credit card balances or short-term loans. Long-term liabilities term includes debts with a term of more than 1 year, such as mortgages or student loans. This classification helps you better understand your payment schedule and plan your finances accordingly. To document your liabilities, gather all your statements for loans, credit cards, and any other debts. Write down the total amount you owe on each account, as well as the interest rates and payment terms. This information will give you an clear view of what you owe, and will help you plan how to handle these debts. When analyzing your liabilities, consider strategies for reducing them. Paying off debts, especially those with high interest rates, not only improves your financial situation but also reduces stress and brings you closer to your financial goals. Identify the debts that you can pay more quickly and consider strategies such as debt consolidation or refinancing for more favorable terms. Understanding your liabilities is essential to maintaining good financial health. An excessive amount of debt can limit your financial options and put your financial well-being at risk. By keeping your debts under control, you ensure that you have better management of your finances and be prepared for unforeseen events or investment opportunities. Identifying and managing your liabilities gives you clearer control over your financial obligations and is essential to creating an effective personal balance sheet. With a complete understanding of your debts, you are ready to calculate your net worth, which is the next step in our process. Now that we have identified both your assets and liabilities, the next step is to calculate your net worth. This figure is the result of subtracting your total liabilities from your total assets. It is a crucial measure of your financial health, as it reflects the real economic value you have accumulated. To calculate your net worth, simply subtract your total liabilities from your total assets. If your assets exceed your liabilities, you have positive net worth, which means you own more than you owe. On the contrary, if your liabilities exceed your assets, you will have negative net worth, indicating that you owe more than you own. Let's look at a simple practical example. Let's say that after adding up all your assets, including cash, $20,000, savings accounts, $25,000, investments, $45,000, and property, $110,000, the total is $200,000. Then, adding your liabilities, such as student loans, credit card balance, and the amount outstanding on your mortgage, comes to a total of $60,000. Your net worth would then be $200,000 to $60,000 equals $140,000. Understanding your net worth is vital for financial planning. It provides you with a clear view of where you are in terms of achieving your financial goals. For example, if you are saving for retirement or your children's education, knowing your net worth helps you evaluate how close you are to those goals. In addition, your net worth can be a valuable tool for making financial decisions. For example, if you have a significantly positive net worth, you might consider making more significant investments or taking certain calculated financial risks. In contrast, a negative or low net worth suggests the need to focus on reducing debt and increasing savings. Calculating your net worth is an essential step to understanding your current financial situation and planning your financial future. This figure gives you a clear basis for making informed decisions and setting realistic financial goals. If you are finding this information useful, I encourage you to leave a like and subscribe so you can continue enjoying more content like this. Let's move forward. Now, we are going to show you how to analyze and interpret the results of your personal financial balance. This analysis is much more than seeing if your net worth is positive or negative. It is understanding what your balance sheet says about your overall financial health and how you can improve it. Analyze the composition of your assets and liabilities. Are your assets composed primarily of liquid investments or real estate? Are your liabilities primarily short-term or long-term debt? The answer to these questions can give you clues about your liquidity and financial strength. For example, a high proportion of liquid assets suggests good liquidity, while a high proportion of long-term debt may signal a significant future financial burden. Look for strengths and areas of improvement in your balance sheet. If you have a strong net worth and a good mix of assets, these are clear strengths. On the other hand, if you find that you have a significant amount of high-interest debt, this is an area that needs attention. The goal is to identify these points and come up with a plan to build on your strengths and address your weaknesses. Use your balance sheet information to plan and set financial goals. If your goal is to buy a home, for example, your balance sheet can help you determine how much you need to save for a down payment. If you're planning for retirement, your balance sheet shows you how much you have accumulated and what you need to do to achieve your retirement goals. Also, remember that your financial statement is a snapshot of your financial situation at a specific point in time. It is important to update it regularly, ideally once a year or after significant changes in your financial life, such as a new job, a major purchase, or changes in your investments. Regular updates allow you to track your progress over time and make adjustments to your financial planning. Setting reminders or including these reviews in your annual financial calendar can help maintain this habit. Personal finances are not static. They change over time due to variations in income, expenses, investments, and debt. Therefore, keeping your balance sheet up to date is crucial to having an accurate representation of your financial situation. During each review, assess whether you need to make adjustments to your assets and liabilities. For example, if you have paid off a significant portion of your debts, this should be reflected in your liabilities. Likewise, if you have made new investments or your existing assets have changed in value, update these amounts. Rebalancing your investments may also be necessary to align your portfolio with your current objectives and risk tolerance. Use your balance sheet review as an opportunity to reflect on your financial goals and strategies. Are you making progress toward your long-term goals? Do you need to modify your savings or investment strategies? This is a good time to evaluate and adjust your financial plans depending on the changes in your life and your objectives. As you progress on your financial journey, you may find new items to add to your balance sheet. For example, if you start investing in retirement funds or purchase a new property, be sure to add these assets to your balance sheet. Likewise, any new debt or change in your liabilities should also be reflected. Remember that a well-maintained personal financial balance gives you a clear and accurate view of where you are financially, which is essential for making informed decisions and planning your future. It empowers you to set realistic goals, identify growth opportunities, and be prepared for financial challenges. I encourage you to study what you have learned today and apply it in your life. Start building your personal financial balance today and make it a regular part of your financial planning. With dedication and constant attention, you can take control of your financial future and work towards your dreams and goals. Thank you for joining me in this video. I hope the information provided has been very useful to you. If so, please give me a like and consider subscribing to the channel for more valuable content on personal finances. Don't forget to share this video with friends or family who could also benefit from learning how to better manage their finances. See you next time.